Welcome to Comments Podcast, the show where we discuss a variety of topics with your host, Nina. At the G20 summit in Rome recently, countries agreed to the Organization for Economic Cooperation and Development, OECD's proposal to establish a minimum 15% global corporate tax rate. Although this proposal was initially agreed in principle at a meeting back in July, it is only now that the agreement has been formally finalized. The new corporate tax rate will be applied in 2023 to all global companies. Some may wonder what's wrong with the current tax system. The current tax system costs governments a loss of approximately, it's estimated, $500 million in lost corporate tax revenue annually, according to the International Monetary Fund. This new tax legislation will prevent large multinational companies from having their tax deducted according to the location of their office or headquarters. Instead, the companies will have the tax applied according to where the company's goods and services are purchased by customers. It is a question of equitable taxation, or ensuring that multinationals which are predominantly operating online are not taxed solely where their company headquarters are located, often in low-tax countries. Currently, no tax is liable from where the company's sales are derived, which results in a loss of substantial tax receipts for governments in many nations. Additionally, this new fixed rate global minimum corporate tax set at 15% will ensure uniformity in corporate taxation internationally. The new global corporate tax agreement will ultimately ensure that tax arrangements are fairer and close existing loopholes. In an ever-increasing globalized world, along with the substantial increase in digital sales and services in recent years, an overhaul of the international tax system was required. The tax will only impact a minority of large multinational companies who have an annual turnover in excess of 750 million euros. Small and medium-sized businesses and other larger corporations, companies will remain unaffected by the new tax rate, and there will be a transition period for companies to 2023 to prepare for the implementation of the new tax. Over the years, there has been a public outcry expressed at how big corporations were enabled to pay lower amounts of tax by relocating their headquarters in low tax rate countries or havens. The argument has raged on for many years for companies to have tax deductions according to which countries their customer sales services are based and not their headquarters location. This global minimum corporate tax will ensure the end of this practice, at least within the domain of the nations who have signed up to the agreement. But substantially or finally, the global minimum corporate tax becomes a reality following years of negotiations and debate. Despite 132 companies having already signed up to the agreement upon the new international tax rate of corporate tax rate, shall we say, of 15%, there are still a few countries abstaining. These currently include Nigeria, Kenya, Pakistan and Sri Lanka, but they remain a small minority, and the good news is a large number of 132 countries will comply with adopting the newly established global corporate tax rate. The tax rate of 15% is still relatively low and fair, and it shouldn't ensure that foreign direct investment in many countries will remain unaffected. Overall, the time for tax reform was necessary, and the global minimum corporate tax system establishes a new benchmark in the international taxation system, which is fair and equitable for all. Thank you for tuning into today's episode. You can subscribe to the Comments podcast via iTunes, Spotify, and other major podcast providers.